Is $10,000 gold inevitable? The secret money shift no one is talking about. There is an old saying, a piece of timeless financial wisdom, that suggests the value of 1 tola of gold should be enough to cover a middle-class family's entire monthly expenses. This wasn't just a quaint proverb, it was a practical ratio, a way of anchoring household economics to something tangible and enduring. If 10 grams of gold cost a certain amount, that figure was considered a benchmark for a sustainable monthly budget. Today, as we witness a historic and almost unbelievable surge in the price of gold, that old saying invites a profound question. Are we on the cusp of a new golden era, one where the precious metal reclaims its ancient monetary throne, and could its price truly reach the staggering height of $10,000 an ounce? To even begin to contemplate such a future, we must first understand the seismic shifts that have brought us to this point. The current record-breaking rally in gold is not a sudden event, but the culmination of forces that began gathering momentum in the autumn of 2022. Back in October of that year, gold was trading in a range near $1,650 per ounce. Fast forward to today and we see prices that have not just climbed, but have effectively doubled, soaring past $3,700 and showing little sign of losing upward momentum. This isn't just a bull market, it's a structural revaluation of one of humanity's oldest assets, a phenomenon that has left even seasoned market observers struggling to keep pace and has generated returns that dwarf most global equity markets. The journey from $1,600 to over $3,700 in roughly 3 years represents a compound annual growth rate nearing 27%. To put that into perspective, it's a pace of wealth creation that very few conventional investments can claim to match. This explosive ascent demands a deeper analysis. It forces us to ask what fundamental drivers are powering this move, and whether they possess the staying power to propel gold into uncharted territory. This is not about speculative frenzy. It is about a profound realignment in the global financial order, where the very nature of money, debt, and risk are being reevaluated before our eyes. To unravel this complex story, we must look beyond the daily price charts and identify the primary actors driving this unprecedented demand. The narrative of this rally is built upon 3 powerful pillars, each reinforcing the other. First, and perhaps most significantly, is the relentless and historic accumulation of gold by the world's central banks. Second is a powerful and growing demand for physical investment, not in the form of ornate jewelry, but in the raw, unadorned purity of gold bars. And third, we are seeing a resurgence of interest in gold-backed exchange-traded funds, or ETFs, which provide a liquid and accessible way for investors large and small to gain exposure to the physical metal. These 3 forces are converging to create a demand storm unlike any we have seen before. Let's first examine the most powerful player at the table, the central banks. For the past few years, these institutions have been purchasing gold at a breathtaking pace, acquiring over 1,000 metric tons annually. This is more than double the average rate of buying seen in the years prior. Central bank activity now accounts for nearly a quarter of all global gold demand, a staggering figure that reshapes the entire market. Nations like China, India, and Poland have emerged as major buyers, systematically increasing their gold reserves. This isn't a random occurrence. It's a calculated strategic shift with deep geopolitical roots that trace back to a singular transformative event. The catalyst for this global gold rush can be traced to the geopolitical fallout from the war in Ukraine. When the United States and its allies took the unprecedented step of freezing Russia's foreign currency reserves, it sent a shockwave through the international financial system. For decades, the global norm was for countries to hold their national savings in U.S. dollars primarily by purchasing U.S. Treasury bonds, long considered the world's safest and most liquid asset. That single act of freezing Russia's assets shattered this perception of absolute safety, introducing a new and potent variable into the equation of reserve management, counterparty risk. Suddenly, holding dollar-denominated assets carried a political risk that had never been so starkly demonstrated. In response to this new reality, a powerful trend of de-dollarization has begun to accelerate across the globe. Nations are actively seeking to reduce their dependence on the U.S. dollar and diversify their reserves into assets that lie outside the direct control of any single government. Gold, as a neutral reserve asset with no counterparty risk, has become the primary beneficiary of this strategic pivot. We have witnessed countries like China systematically reducing their holdings of U.S. bonds while simultaneously ramping up their purchases of physical gold. This is a quiet but monumental revolt against the dollar's dominance, and it is fundamentally altering the architecture of global finance. This shift represents a return to first principles for central bankers. They are rediscovering gold's timeless role as the ultimate store of value, an asset that protects against crisis, hedges geopolitical risk, and provides true diversification. This is not merely about hedging against inflation. It's about insulating their national wealth from the weaponization of finance. The fear is no longer just economic but existential. What if your nation's savings could be confiscated overnight due to a political disagreement? This question is now at the forefront of every central banker's mind, and their collective answer has been to buy gold, creating a powerful and sustained source of demand that provides a solid floor under the market. The second pillar supporting this golden rally is a fascinating divergence in the physical market. While central banks operate on a macro level, individual behavior is also telling a compelling story. Traditionally, a significant portion of physical gold demand came from the jewelry sector, particularly in cultural powerhouses like India and China. However, as gold prices have surged to record highs, the affordability of jewelry has plummeted. The data from the World Gold Council is unequivocal. Demand in the jewelry segment has seen a notable decline, hitting its lowest point since 2020 as consumers balk at the high cost. It is a common belief that our homes, particularly in India, hold thousands of tons of gold in the form of ancestral jewelry, a testament to its deep cultural significance. While the exact figures are unknown, this cultural affinity has historically driven massive demand. But the current price environment has changed that dynamic. The data shows that in the second quarter of 2025, jewelry demand fell significantly. Consumers are simply buying less. This decline, however, is not a sign of waning interest in gold itself. Instead, it reveals a crucial shift in consumer and investor psychology, a pivot from gold as a discretionary adornment to gold as a primary investment vehicle. In stark contrast to the weakening jewelry market, the demand for investment-grade physical gold, specifically in the form of gold bars, is experiencing a powerful surge. Investors are making a clear and logical choice. When you purchase a piece of jewelry, you pay for the intricate manufacturing, the design, and the branding, all of which are encapsulated in a making charge. When you decide to sell that piece, these charges are typically deducted, resulting in a financial loss. Gold bars, on the other hand, represent the purest form of investment in the metal. Their value is tied directly to the spot price, with minimal premiums, making them incredibly easy to buy and sell with a much higher resale value. This trend reflects a more sophisticated approach from the modern investor. They are bypassing the sentimentality of jewelry and focusing on the core function of gold as a store of wealth and a financial safe haven. This surge in physical bar investment provides another layer of solid, tangible demand that is less susceptible to the whims of fashion or seasonal occasions. It is a calculated, long-term allocation of capital by individuals who share the same concerns as the central banks: the erosion of currency purchasing power, rising inflation, and escalating geopolitical instability. This is not speculative hot money. It is a deliberate flight to safety in its most tangible form. The third and final pillar of this rally is the renewed vigor in the gold ETF market. These financial instruments, which are backed by physical gold stored in secure vaults, offer investors a highly liquid and cost-effective way to participate in the gold market without the complexities of storing and insuring physical bullion. After several years of outflows, we are now seeing a significant reversal, with hundreds of tons of gold flowing back into these funds. In the first half of 2025 alone, gold ETFs recorded massive inflows, marking the strongest start to a year since 2020. This influx of capital into ETFs is a critical component of the price rally because it amplifies demand. Every dollar invested in a physically backed ETF translates into a real-world purchase of gold bullion, further tightening the available supply. The total holdings of gold ETFs globally have now climbed back to their highest levels in years, approaching the record peaks seen previously. This trend indicates that not just central banks and private individuals are turning to gold, but a broader swath of the investment community, including institutional funds and portfolio managers, are increasing their allocations, seeking both a hedge against market volatility and a direct participation in gold's powerful uptrend. When we synthesize these three driving forces, relentless central bank buying, a strategic shift to physical bar investment, and powerful inflows into ETFs, a new picture of the gold market emerges. It is a market where the traditional drivers are being supplanted by powerful new ones. A look at the composition of gold demand over the last decade reveals this inflection point with startling clarity. Whereas jewelry fabrication once accounted for well over half of all demand, its share has steadily fallen. In its place, the shares of central bank net purchases and physical investment have grown dramatically, fundamentally altering the market's character. This is not merely a cyclical upturn, it is a secular shift. Gold is transitioning from a hybrid commodity and consumer good into a primary monetary asset. The marginal price of gold is no longer being set by a bride in India or a gift giver in China. Instead, it is being dictated by the strategic decisions of the People's Bank of China, by the risk calculations of a global pension fund, and by the individual investor seeking to preserve their wealth in an increasingly uncertain world. This change in the nature of demand is crucial because it suggests a higher and more durable price floor for the metal moving forward. This new reality is beginning to be reflected in the forecasts of major financial institutions, who are racing to revise their price targets upwards. Investment banks like J.P. Morgan and UBS are now projecting that gold could reach $4,000 an ounce or even higher in the medium term. While just a short time ago such predictions might have seemed outlandish, they are now becoming the consensus view. These forecasts are not just numbers on a page. They represent a significant shift in institutional sentiment, an acknowledgement that the underlying fundamentals of the gold market have been irrevocably altered. The question is no longer if gold will rise, but how high it can ultimately go. This brings us to the most provocative question of all. Could gold truly hit $10,000? To explore this possibility, we need to step back from the immediate drivers of supply and demand and look at a much deeper, almost philosophical relationship: the connection between gold and the supply of money itself. The old proverb about one tola of gold covering a month's expenses was not just about price. It was about a stable relationship between real value and the cost of living, a relationship that has been severed in the age of fiat currency. Gold has always been seen as a hedge against inflation, a tangible anchor in a sea of endlessly printed paper money. Let's consider the concept of the M2 money supply, which is a broad measure of the total amount of currency in circulation, plus various forms of bank deposits. It represents the vast ocean of liquidity within an economy. Historically, there has been a loose but persistent correlation between the growth of the money supply and the price of gold. When central banks create vast sums of new money, that liquidity must flow somewhere. Like a river seeking its level, it flows into assets, often chasing tangible stores of value that cannot be debased by a printing press. Gold, in this context, acts as a governor on monetary excess. The events of the last several years have supercharged this dynamic. Since 2020 alone, the United States has expanded its money supply by trillions of dollars, an unprecedented flood of liquidity injected into the system to combat economic shutdowns and stimulate growth. If you were to plot the M2 money supply on a chart alongside the price of gold, you would see a dramatic divergence. While the money supply has soared to stratospheric levels, the price of gold, despite its recent rally, has lagged significantly behind. Some analysts argue that for gold to simply return to its historical relationship with the money supply, its price would have to be substantially higher than it is today. This is not just an abstract theory, it's a reflection of a world drowning in debt. The total global debt now stands at a staggering figure, with the United States alone accounting for a national debt approaching $40 trillion. This mountain of debt creates a powerful incentive for governments and central banks to pursue inflationary policies. Inflation is a subtle but effective way to devalue that debt over time, making it easier to repay in the future with cheaper currency. As a non-yielding asset, gold thrives in such an environment because it preserves purchasing power while paper currencies are systematically eroded. We are now entering a new phase of this monetary cycle. The Federal Reserve, after a period of aggressive interest rate hikes to combat inflation, is now signaling a pivot towards rate cuts. Lower interest rates are fundamentally bullish for gold for two key reasons. First, they reduce the opportunity cost of holding a non-yielding asset like gold, making it more attractive compared to bonds that now offer lower returns. Second, rate cuts tend to weaken the U.S. dollar, and since gold is priced in dollars globally, a weaker dollar generally leads to a higher gold price. This creates a powerful tailwind for the precious metal. This policy pivot by the U.S. may also be part of a larger unspoken global strategy, a currency war. In a world of high debt, nations may be deliberately seeking to devalue their currencies to make their exports cheaper and to inflate away their debt burdens. China has long managed its currency to its own advantage, and now there are growing suspicions that the U.S. is indirectly engineering a weaker dollar through its monetary policy. In a race to the bottom for fiat currencies, gold stands apart as the one form of money that holds its intrinsic value, making it the ultimate winner in a global currency conflict. When we bring all these threads together, the strategic de-dollarization by central banks, the fundamental shift in physical investment demand, the renewed inflows into ETFs, the astronomical levels of global debt, and the impending cycle of interest rate cuts and currency devaluation, the case for a substantially higher gold price becomes not just plausible, but compelling. The forecast of $10,000 an ounce ceases to be a wild prediction, and instead becomes the logical endpoint of these converging global trends. It represents a potential re-anchoring of the financial system to an asset that represents stability in an age of unprecedented instability. Of course, no path is without its risks. A sudden and unexpectedly hawkish shift from the Federal Reserve, a significant strengthening of the U.S. dollar, or a resolution of major geopolitical conflicts could all create headwinds for gold and trigger periods of consolidation or correction. The market is never a one-way street, and profit-taking will inevitably occur along the way. Yet the underlying structural forces powering this rally, the deep-seated distrust in fiat currencies, the strategic imperative of de-dollarization, and the mathematical reality of global debt, are not trends that are likely to reverse anytime soon. The world is undergoing a profound financial reset. The post-World War II dollar-centric order is fracturing, and in its place a more multipolar and uncertain world is emerging. In this new landscape, nations and individuals alike are searching for an anchor, a reliable store of value that can withstand the storms of geopolitical conflict and monetary debasement. Gold has played this role for millennia, and the evidence strongly suggests it is reasserting its position as the ultimate safe haven asset for the 21st century. The record-breaking rally we are witnessing is therefore more than just a bull market in a commodity. It is a referendum on the state of the global financial system. It reflects a growing consensus that the unprecedented monetary experiments of the last few decades are reaching their logical conclusion. The staggering increase in money supply and government debt has created systemic risks that can no longer be ignored. Gold's ascent is a direct consequence of this loss of faith in the traditional pillars of the financial world. Looking forward, the momentum appears to be firmly on the side of gold. The very reasons that central banks are buying, geopolitical risk, and a desire to diversify away from the dollar, are long-term structural issues. The individual's flight to physical bars is a rational response to persistent inflation and economic uncertainty. The flow of funds into ETFs signals a broader institutional acceptance of gold's role in a diversified portfolio. These trends are not fleeting. They are foundational shifts that are likely to persist and even intensify in the coming years. The question of whether gold will hit $10,000 is ultimately a question of how these powerful, long-term trends unfold. It is not a matter of if, but when the full consequences of decades of monetary expansion and debt accumulation are realized. The data strongly suggests that gold's value, when measured against the sheer volume of currency that has been created, remains significantly undervalued. The path to $10,000 would not be a straight line, but it represents a logical destination in a world that is desperately seeking a monetary anchor. In conclusion, the forces propelling gold to record highs are powerful, multifaceted, and deeply entrenched in the current global economic and geopolitical landscape. The era of central bank dominance, the strategic pivot of individual investors, and the undeniable mathematics of money supply and debt all point in the same direction. While no outcome is ever guaranteed, the evidence suggests that the current rally is not an endpoint, but rather the beginning of a major revaluation of gold's role in the world. The ancient wisdom of 1 tola of gold may once again prove to be a remarkably prescient guide in a future where tangible value becomes paramount.